Okay, hello everybody. Welcome to Korean Atlanta Mentorship. It's a little bit over 7 p.m. Eastern in the Atlanta area, and we're going to conduct what we call Velocity Banking Sunday service. So all it is just a quick review of Velocity Banking on a Sunday before you all start the work week. And hopefully some of you don't have the Sunday scaries. And if you don't know what that is, that's the feeling of anxiety that you have before on a Sunday before you go to work on Monday because you're anticipating that you have to work. I heard it's a common condition with teachers. Now, hopefully you don't feel that. Okay, so we're going to start our review of Velocity Banking, and let's just do this. So let's just start off with velocity banking requirements. And what are the two requirements that I always talk about in pretty much every single video that we do? First of all, we need a budget, right? We need a budget. And once we have a budget, then we have to do the second thing to do velocity banking, which is select our operating account, which is the line of credit. Okay. So again, line of credit, if you have a credit card, that's a line of credit. All it is a financial tool where you could borrow money, pay it back, and use it over and over again. Okay? So luckily, I have a budget that's pre-made for me here, where with this person, we have a $4,000 paycheck, right? And you can go ahead and create this spreadsheet yourself from scratch. It's relatively easy. And we're going to say this person has about, I don't know, $3,000 in expenses. So $1,000 in checking savings, zero in cash flow. And you might be thinking, hey, why is this cash flow zero if the pay income is more than expenses, right? And that's because the way that cash flow is described when we talk about velocity banking is what is your money doing for you? And so if you have or $1,000 in checking and savings, kind of doing nothing, but you have maybe like loans at 6%, maybe $23,000 in loans at 6%, and this whatever this is growing at 0.001. It's kind of like stale water at that point. Now I know that technically it's not zero from a real estate cash flow perspective, but just bear with me here. Okay, so now once we have written down our budget, right, then we always do an expense breakdown. And so once we do the expense breakdown, we're going to write down every single debt that we have. This is the most important thing when we do the expense breakdown. Writing down every single debt that we have as its own line item. So in this example, we have the student loan and the auto loan. And then we put rent here and the other food, gas, insurance, etc. We could actually combine these, but I always like to separate them out because people know what they pay in rent from per month, but they don't know what they pay with all the other stuff because it's just like swiped on a credit card, set and forget it. They don't really follow this to exact T as they do with the rent. Okay. So now let's go ahead and make sure that our expenses equals $3,000. So 400 a month, 600 a month, right? That's 1,000, and then we'll put $1,000 for rent, and then $1,000 for food, insurance, gas. So this will certainly equal $3,000 a month. Now, let's go here. We've completed step one, which is our budget. Now we need our operating account, which is a line of credit. So there's various types of lines of credit. There's credit cards, there's personal lines of credit, there's home equity lines of credit. I have all three, right? So for example, I have a home equity line of credit that's $50,000 that has a $50,000 limit. So think of it as like a credit card, almost like a credit card where you could draw up to $50,000. If you don't pay it back, then your house is collateral, right? So that's what a home equity line of credit is. And I also have a personal line of credit up to $15,000. So what I'm going to do is I'm going to select that as my main operating account for this example. Now I know some of you might be thinking 15,000, that's a lot for credit cards. To me, it's not, right? And I said this in other videos. I have $215,000 in total credit limits with lines of credit, right? So if you know how to build up your credit, just here's a shortcut rule to know, and this isn't actual real advice, it's kind of like pseudo advice, but here's an easy way to figure out if banks will lend you money and credit is the moment you actually need the money is the moment they probably won't give it to you, right? So make sure that if you're building your credit and credit profile, always do it honestly and ethically, right? Don't ever lie, but do it at a point where you don't really need it. And then once you actually do need it, then you'll be able to use it, right? The problem is that people try to get credit when they need it and then wonder why they get denied because banks don't lend you money when you need it. Okay? All right. So let's say I'm using a personal line of credit at a $15,000 limit. So with this personal line of credit, I can click a button on the bank's website, take it out, right? And then it'll be in my checking account. Now, so this is the average American's finances. And again, some people have been asking, like, why do you call it the average American? This situation is global, and that's because it's a derogatory term. Kind of like SAD. I don't know if you ever heard of that one. Standard American diet. There's a reason why it's sad, right? Just like because the average American situation is sad. And there's a reason why, all the bad things usually in modern society kind of start in the United States and then they spread to the globe. It's usually what happens. But enough of that. Okay. So back to my point is the only difference between the average American and the Velocity Banker is that what's the operating account? So the average American is the checking account, right? So all your bills are paid from the checking account. Now, when you do Velocity Banking, the only real difference is that your operating account is your line of credit. So what we're going to do is going to re-engineer some of our finances to free up some cash flow and pay off our debt quickly, right? An easy set it and forget it system. So what I'm going to do is we're not going to make any money, 4,000, right? We're not going to make more money, but we're going to figure out what's an easy way to quickly pay off our debts, right? So we have the student loan for $10,000 balance, $400 a month, auto loan, $13,000 balance at $600 a month, rent, food, insurance, gas. So let me just do this. No matter what we do, the rent will stay the same, at least for the term of the lease, and so will the food, gas, insurance, and all the other stuff. But what we can do is be able to free up some cash flow. Now, in my other examples, I always put $25,000 because that's a very convenient number, but we'll kind of reduce it by 10,000 to see how this would work. So we can either pay off this student loan with our line of credit or our auto loan, and there's various ways to figure out which one to pay off first. So some of the criteria you might use is a combination of the lowest balance, the highest monthly payment, and the highest interest, right? And you could also use a formula called the cash flow index, which is a formula created by, I think, The Wealth Factory by Garrett Gunderson. You could do a Google search on that. But all that is just the loan amount, so 10,000 in this case, divided by the monthly payment. Okay, so, and it's just an arbitrary number. So let's go ahead and highlight cash flow index. And then this one right here, it'll be 13,000, which is the loan amount, divided by 600. And so that cash flow index is 21.6. And the idea is the bigger the number, like if you're like one above 50, it's a loan that you don't really want to pay off quickly because it's, quote, an efficient loan because you're not paying as much of a monthly payment compared to the actual loan balance. But here, if it's lower than 50, then it's considered to be inefficient. And the lower the number, that's the one we want to quickly pay off. So as you can see here, since this one is lower, I want to pay off this one. And if you study the cash flow index, it actually tells you to ignore the interest rate. Now, I would sometimes focus on the interest rate. So I'm not saying that's 100% foolproof method, but for example, let's say I had a 0% credit card, and this number is really low. I probably still wouldn't want to pay that off quickly, right? That's just my 2 cents. Now, so I know from the cash flow index, looking at these two numbers, I want to pay this one off quickly, right? So what we do is we go to the bank's website, put $13,000 right here, and what we're going to do is put $13,000 from our checking to our checking and savings. You just go to the bank's website, click a button, bam, and the 13,000 comes our checking and savings. And then what we do is we pay off this auto loan with our checking savings, and this goes to zero, okay? And then this goes to zero, all right? And then, so the student loan is still there, And so now what's our expenses? So our expenses are 2,400, 2,400. Okay. So what's our monthly cash flow? It's C2 minus C3. Oops, I screwed up. Should be C3. Okay. So now our cash flow is 1,600. And so the basic strategy is you put your entire paycheck from the line of credit, I'm sorry, not from your checking account to the line of credit, and then you take off your expenses accordingly. So think about this. So let's say we'll call this month 0, right? And in month after so let's say you dump your entire paycheck to here. So eventually this will be, let me put this here. I'll give me 1 second. So let's say this eventually turns to like 9,000. Was it 9,000? Yeah, it's 9,000. And then you take out your expenses from the line of credit, which will be 2,400, right? So this will, it goes to 9,000, and then you add 2,400 to it. So eventually the next month will be approximately the previous month's balance minus the cash flow, which is this 1,600 right here, right? Okay. Now, again, we're not calculating the interest. I always like to do that a little bit separately, even though it's not totally accurate how this is done. Obviously, after every single month, what happens is that the bank it doesn't take the previous month's balance, it takes the previous month's average daily balance and calculates the interest from that, and you have to pay it every month. Now, the reason that I don't do that is just for the sake of simplicity and the fact that you don't know what the average daily balance will be when you're doing velocity banking, because you could take out certain expenses in different days, right? But let's go ahead and copy and paste this formula. So it's the previous cell, H2 minus the cash flow. And let's go ahead and do that. And we'll see how long it takes for us to pay off this loan, right? So it'd be 1, 2, 3, 4, 5, 6, 7, 8. And okay, so what's our cash flow here? Okay, I'll put 0 for here. Okay, so now what we need to do is we haven't taken into account the interest. Now, obviously, what you would do to calculate the interest is take like I said, the average daily balance of the previous month, but we actually don't know that, right? So what we're going to do is just kind of overestimate the interest by just taking the previous month's balance. And this is kind of inaccurate, but it's good enough. So 15%, right? So we take the previous month's balance, multiply by 15%, and then divide by 12, and that will give us the monthly interest. And so realistically, when we do this, we're going to put our entire paycheck in. And so our monthly balance isn't actually going to go down by their entire cash flow. You're going to pay the interest, and then the rest will be the actual cash flow that brings down the balance. But what I like to do, just kind of for the sake of simplicity, is that I like to just do it, kind of add the interest at the very end, even though that's not how it's done, just because it makes my life simple and the calculation will kind of pretty much be the same. Okay, so now let's go ahead and sum this up. So if you don't know the sum button, all you got to do is just click this right here on top, auto sum, and tell you how much interest you paid and how long it took. So this is about $742. And if we add that here, that will definitely be within our cash flow, which is 1,600. So this is only going to take us 8 months, right? It's only going to take us 8 months, and we only have to pay $742.05 in interest. So let me just write that here. So 8 months payoff and $742.50 in interest. Okay. So let's go back here. Okay. And now we have this student loan. Now, after paying it for about 8 months, it's definitely not going to be $10,000. I'm aware of that. But again, be accurate. Don't be so accurate where it's good, where you feel like you're prevented from doing the strategy if you don't have every single number down to the T. but it's almost impossible to have every single number down to the T because you don't know what the average daily expenses are. Now, again, this is not going to be $10,000, right? After 8 months, it's going to go down. I don't know about how much, but if I do 8 times 4, that's 3,200. Actually, let me think about this. 3,200, right? But I know that, okay, so I don't want to waste too much time here, but we paid $3,200 of payments, but I don't know if they'll go down by that much, but it's okay. Let's just put $10,000 here. Again, make our life simple. And so in many ways, we're overestimating the payoff and the amount of interest that we're going to pay, but it's all right. Okay, so now what's our cash flow? So what we do is when we move this loan, so it's like you would click the bank's website, 10 grand goes here, bam, 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 10 grand. And then this 10 grand is going to pay off the student loan. Again, it's not going to be 10 grand. It's going to be something less, but I'm too lazy to calculate it. I'm just, doing good enough is good enough. And then this will go to 0. And then this will go to 0, right? So now what's our cash flow? Our cash flow, okay, is going to increase by $400 a month because our expenses are now only $2,000, right? So let's do 2,000. And now, okay, let's see how long it takes us to pay this off. Again, we're just approximating this. So now what this is we're going to do the previous month's balance minus $2,000. Whoopsie, I did the formula incorrectly. Equals, all right. And let's see how long it takes us to pay this off. 0, 1, 2, 3, 4. All right. So about 4 months. Let's calculate the interest, which will be, let's take a look. So this will be previous month's H2 times 0.15 divided by 12. Okay, and let's go ahead and sum it up. So this will be $375, right? So if this is $375 and this is 2,000, so it's probably going to take an extra month to pay this off, including the interest here. So let's just put here 5 months payoff and $375 in interest. Okay, so now we got that covered, right? So we're good. And ta-da, we paid off. How much is this? It took us 13 months in total to pay off 23 grand. And the total interest, so let's go ahead and calculate the total interest. Let's do this. 375 plus 742.5. So it took us about $1,117 in interest. So that's pretty good, right? So I don't know about you, but how many people do you know who only have $1,000 in checking and savings? It's not like paycheck to paycheck, but it's kind of somewhere close. I mean, $1,000 isn't a lot. Maybe we wish we had more buffer, but who's able to pay off $23,000 in loans, and it only takes 13 months, so a little bit more than a year, to pay off 23 grand, and all it was is $1,000 in interest, right? So again, just practice the same scenario over and over again, and you'll be able to easily pay this off without thinking about it. The way that I think about velocity banking is that it's a set it and forget it system, because all I have to do is just dump my entire paycheck into one place, which is the line of credit, and then take out my expenses from it, and that's it. Okay, well, this is Korean Atlanta Mentorship. If you're interested in joining our group, go ahead and click the Google form link below. Have a great day, happy Sunday, and we will speak next time.